Today we're going to be talking about a concept that might seem a little bit intimidating at first, but is actually really important for new investors to understand: market capitalization, or market cap for short. When it comes to evaluating the value of a stock, many people tend to focus on the stock price. But my friends, this is a mistake. The stock price is a metric that can be affected by all sorts of short-term factors, but the true measure of a company's value in the stock market is its market capitalization. So what is market cap? Market cap is simply the total value of all the shares of a company's stock. It's a more reliable indicator of a stock's true value because it takes into account not just the stock price, but also the number of outstanding shares. For example, let's say Company A and Company B are both in the technology industry and both have the same stock price of $50. However, Company A has 10 million shares outstanding and Company B has 100 million shares outstanding. Based on the stock price alone, it may seem like both companies are similarly valued. But when you look at the market capitalization, the stock price multiplied by the amount of shares outstanding, you can see that Company A has a market cap of 500 million and Company B has a market cap of 5 billion. Company B is much larger and much more valuable than Company A. Why else is market cap such an important concept for investors to understand? First of all, market cap is a good way to gauge the size and scale of a company. Generally speaking, larger companies tend to be more stable and less risky to invest in than smaller companies. So if you're trying to decide whether to invest in Company A or Company B, looking at their market caps can give you an idea of which one is more established and potentially more reliable. Another reason market cap is important is that it can give you an idea of how much a company is worth as a whole. If a company has a high market cap, that means it's worth a lot of money, which can be a good sign for investors. On the other hand, if a company has low market cap, it might be riskier to invest in because it's worth less overall. Of course, this isn't true all the time. Market cap is just one factor to consider when it comes to investing. It's not the be-all and end-all, and there are plenty of companies with low market caps that have done really well for investors. That's why it's important to do your own research, and not just rely on market cap as the sole criteria for making investment decisions. So where did market cap come from? It's actually a pretty old concept. The origins of market cap can be traced back to the late 19th century, when investors began to realize that the stock price alone wasn't enough to understand a company's value. The term market capitalization was first coined by Benjamin Graham, a value investor and economist in the 1930s. But it really gained popularity in the 1970s, when mutual fund pioneer John Bogle started advocating for it as a way for investors to evaluate the size of a company. And he was right. Market cap became widely adopted by institutional investors as a way to quickly and easily compare the relative size of different companies. Today, market cap is considered a key metric for evaluating a company's value and is used by investors, fund managers, and analysts worldwide. So there you have it. That's the basics of market cap and why it's such an important concept for new investors to understand. It's not a magic formula, and it's not the only factor to consider when it comes to investing, but it's a useful tool to have in your toolkit as you navigate the world of stocks. If you have any questions or want to learn more about market cap, leave a comment down below, and I'll be sure to get back to you. Consider liking and subscribing if you found this video helpful. Thanks for watching, and I'll see you in the next one. Market cap. Market cap? Market cap.